A partnership is formed when two or more individuals agree to do business together. Unlike corporations, partnerships allow each partner to contribute in various ways, be it cash, assets, or even skills. The first step in partnership accounting is recording each partner's investments. These are not lumped together. Each contribution is recorded in separate entries to maintain clarity on who has contributed what. When partners contribute assets, these contributions are debited to the partnership's asset accounts. This could include cash, property, or equipment, anything with value that can be used in the business. Sometimes, partners bring in liabilities along with their assets. These assumed liabilities are credited to the partnership's liability accounts, recognizing the obligations the partnership is now responsible for. Finally, after tallying the debits and credits from the contributions and liabilities, the net amount is credited to the partner's capital account. This reflects the partner's equity or ownership in the partnership. Let's consider Joseph Stevens and Earl Foster, owners of rival hardware stores, who decide to put competition aside and join forces. They form a partnership, and now it's time to record their contributions. Joseph Stevens steps up first. He's agreed to contribute a variety of assets to the partnership. This includes cash, accounts receivable, inventory, and equipment. But that's not all. He's also bringing in some liabilities. Stevens's contributions are as follows. He brings in $7,200 in cash, $16,300 in accounts receivable, $28,700 in merchandise inventory, and $5,400 in store equipment. These are substantial assets that will help kickstart the partnership. Along with the assets, Stevens accounts for an allowance for doubtful accounts at $1,500, reducing the value of the receivables to reflect potential non-payment. He also brings in $2,500 in office equipment. However, we mustn't forget about liabilities. Stevens has accounts payable of $2,600, which are obligations the partnership will now need to settle. It's vital for both partners to agree on the valuation of contributions to ensure fairness and transparency from the get-go. When Stevens contributes his assets and liabilities to the partnership, a journal entry is made to capture this transaction. Here's what it looks like. On April 1st, the partnership records $7,200 in cash, $16,300 in accounts receivable, $28,700 in merchandise inventory, $5,400 in store equipment, and $2,500 in office equipment, all credited to Stevens's capital account. But there's a catch. An allowance for doubtful accounts of $1,500 is considered, decreasing the receivables value. Finally, $2,600 is recorded as accounts payable, reflecting the partnership's new liabilities. The net amount is then credited to Stevens's capital account in the partnership's ledger. This figure represents his stake in the business. Now, it's essential to note that non-cash assets are not just recorded at any value. They are recorded at values agreed upon by the partners, typically based on current market values. Because of this, the book value of the assets contributed by partners like Stevens often differs from that recorded by the new partnership. This difference reflects the negotiation and the mutual agreement on the worth of what's being brought to the business table. Accurate recording is crucial. It ensures that each partner's capital account reflects their true stake in the partnership, which sets the stage for how profits and losses will be shared. And there we have it, a clear record of a partner's contributions to a partnership.